What's happening, everybody? First one-on-one of 2026. Shaking off the cobwebs with three industry behemoths. What do you think about that? And I don't mean in size, I mean in stature, starting, of course, with Julia Brown, founder and principal of Telescope Advisors. Julia's just a top-notch mortgage executive, has spent a lot of time in the mergers and acquisition space as well. And so has my colleague, Roque, who has done such amazing things in this industry and continues to help propel NFM, including recently helping us add around $750 million in volume just in the last couple of months. And Coby Hakalir, my man. Coby is the vice president of mortgage and banking at Ancillary Services at T360. What's up, brother?
What's going on, man? Kind of feel like
ready for this? Is anybody out there feeling the cobwebs? The first Monday of January cobwebs. I'm going to raise my hand. I always do.
What's that mean? What do you mean by cobwebs?
It's like your head is you're not like, it's just been so long since we've all hummed, 50, 60, 70 hours a week like we're accustomed to, at least for me. I'm trying to find my feet under me. And they're not big feet, by the way, just a size 8.5.
No cobwebs. I think the cobwebs were like Friday because it was the 2nd. I think first Monday and January being the 5th. A little different, maybe.
I like it. How about you, Rickers?
No, I totally empathize with what you're saying. It's the way where Christmas sort of landed. It just people like leading up to Christmas and the holidays, and then the time between Christmas and New Year's. The last 2 years was just sort of December was a great month for us, and I think for most of major enterprise lenders, December was a really, really strong month. So I think we ended the year with a lot of enthusiasm. I think looking to the new year. But the last 2 weeks, it is hard to kind of get back into the groove of things. But we were able to get some work done over the weekend. Visiting with some of our branches up here in Massachusetts and Connecticut, and go to the Patriots game on. So it was a good weekend. Yeah,
well, the Patriots, man, all they do is win. Great day of football yesterday. I don't know how many of you watched the Steelers Ravens game. Was just insane. I don't know. Yeah. I watched it down to the last minute. Nobody could stop anybody. A missed field goal, a chip shot for the Ravens kicker, who had to just be, so nervous with that raucous crowd there in Pittsburgh. So 2025, we eclipsed 2 trillion. Did you guys know that? 2 trillion. I just got this from Mike Fratantoni, chief economist at the Mortgage Bankers Association, just under the wire. This email came into me. Their estimate, they need to do a revision soon when they get all the HMDA data in. But right now it's 2.05 trillion, 34% refi. Coby, what do you think about that? 30? I'm surprised by that number. Are you?
No, we had, I think we came in right around where projections were estimating we were. I think we were a lot more bullish on, or everybody was, not everybody, but most people were a lot more bullish on where they thought rates were going to land this year than where they actually did. But we did have a couple of little mini refi booms in the mix there. We had, a week here, a day there. So there was time to capture refinances. We also had a lot of people this year that were thinking, all right, my home is appreciated greatly. It's time to take some money out. I think we saw a lot of cash out refinances this year as well that contributed to that number.
Well, Julia, even your dog is excited about this. I just saw the tail over there in the background. Everyone's getting into the action here. Can you call the dog up on stage here? We got, you can't have a pet. You can't have just a tail. Okay. You have to have the whole pet. What do we have here? Who's that? Oh, that's a beautiful dog.
This is Zoe. She needs to go to the groomers, but yeah,
Hi, Zoe.
She wanted to be a part.
Zoe. Wow.
She has eyes under there somewhere. But yeah, she loves refinances. She loves cash out. This dog was an equity purchase. She was a HELOC purchase. Let me tell you.
Hey, listen, I understand. Yeah. You start going to the breeders, and well, that's where I got Rick from. I got Rick from a breeder. I don't know if you knew that. He's a purebred. He's not a mutt by any means.
I would have guessed rescue for sure.
Hey, Julia, I thought that there weren't going to be any refis that went anywhere but Freedom and Rocket. And this is a question. This is I'm grooving a fastball into you right here. You
Yeah.
know what pitch I'm calling. What do you think of that? Like, you've been involved in the mergers and acquisition space. You understand as well as anybody the landscape that we're heading into with this race to have the flywheel and all the different intricacies that go along with it. I personally feel like there's going to be plenty of refi activity for everybody. I don't care how intricate the flywheel is and how many touch points there are. What are your thoughts? And what does that 35% number say to you?
Yeah, I think a lot of cash out refinances exist in that. I think you see probably some IRRRLs and FHA streamlines here and there. And then, like Coby mentioned, like people who wanted to get in when the market was right for them on a day or a week, that it made sense. And their loan officers following back up with them at the right time and having a close, like their finger on the pulse really around that right time would be. I started my career as a refi banker at Quicken Loans back in the HARP days. And we were buying up books of servicing like GMAC at that time, or Senlar, Soteris. We were buying up books of financing and timing when to call people. That was 15 years ago. And so I think execution is more important than the flywheel itself in a lot of ways. Like, sure, the Rockets of the world are going to have a ton of opportunities. You know, anyone who's got those big servicing acquisitions are going to have huge opportunities, but what they make of it is up to them. And some of those companies who did that acquiring are really positioned well to execute, and others maybe still figuring it out.
Well, and how much time do people have to figure it out? Hey, Rick, did you happen to see Maggie May's posts about her experience once her Mr. Cooper loan moved over to Rocket?
Yeah, over to Rocket.
Did you catch that? Catch everybody up on. Let's talk about that. What did you see in that post? And,
well, I
want you all to comment on it.
You know, it might be too early to tell. It might be it's either an indication of things to come, or it's just too early to tell. And Rocket just needs to, revamp its sort of customer ingestion process, because it seemed to me that what she was articulating was the process over at Mr. Cooper was so much smoother, so much easier, and so much better than now that it's over at Rocket. The process has become a lot more cumbersome. I wouldn't, when it comes to technology, I wouldn't count Rocket out, right? This is their lifeline. This is their book of business. So I think they're going to be a lot more aggressive on the conversion because they don't have the origination, I think, channels in the way that like UWM has, which is where they lost sort of their grip. They didn't capitalize on the servicing side in as much as the origination side. And so they lost their footing to UWM. But I do think that from a technology, they'll figure that out. I mean, this is what Rocket does, right? So I don't think I'm too concerned about that. But it did create a narrative of like, and this is how you opened the show, is all the hype around the servicers automatically, claiming the conversion of the business? Is that really as guaranteed as everyone is afraid it is, or is that overblown?
And what's the answer, Coby?
Well, I mean, first of all, I think I saw the post about, the transition from Mr. Cooper to Rocket. I would say that if it was 100% smooth, then I would say, hey, they haven't really begun their true vertical integration yet. There's going to be growing pains when you merge those kind of organizations together, and processes and workflows and a whole different way of approaching the customer and updating systems. I mean, that's a massive, massive project. There's going to be some breakage along the way. Is it a guarantee that the servicers are going to come into the refinance market and just tread all over everybody mercilessly and take everyone's market share? No. Are they a big interrupter? Absolutely. What I think they do create is some positive downward pressure on the rest of the industry to up their game and figure out, why are we losing 75 to 80% of our customers once they close a deal with us and never coming back? Mm-hmm. Why do we have such a poor record of retaining our customers and getting repeat business out of them? Why are we so transactional versus relational?
Yeah. The Redder loan loss report is just insane. I don't know if you guys know what that is, but Redder's a market intelligence company. Think MMI, Modex, Big Purple Dot, Ingenious. They're all great companies. Redder created this tool that allows you to go in and see how many of your loans in a calendar year where you did the last loan, how many walked out the door. And I was very transparent that at NFM, we lost like 75% of the opportunities in 2024, meaning the customer did the last loan with us and then went elsewhere for their next one. And that's a problem. Like we're worried about all these people are going to move our cheese. Nobody's doing a good enough job protecting their own cheese. And 2 top 5 lenders, I ran the same analysis for them. One was better than the other, but collectively they lost about 3.6 billion, 25,000 loans between the two of them, just south of 25,000 loans. I mean, that's insane, Julia.
That's insane.
I mean, I don't even know how that even happens. Like, if the industry just got 10% better, we'd be set for 2 or 3 years.
Yeah.
So what does it take for a company to set up a system that is not a distraction for its sales force to follow up on these leads, these prospective leads, that's effective? Like, what is the cost of that? What would our CAC be on retaining and doing refinances for these clients or new purchases for these clients, as opposed to standard or traditional CAC with, JVs or marketing expenses, shared marketing budgets with realtors? Like, it's worth exploring and considering for any IMB out there.
Well, what's the answer? This is what you do, Julia, right? This is part of why you went out on your own. I mean, Telescope Advisors. I love that name. Like, let's look a little deeper at this problem. So what are some of the solutions that you're out there sharing?
Well, I've got a client right now who's exploring this. It's a division within a mortgage company that does like 97% purchase transactions. I think they did like 3 or 4 refinances last year because they're so focused on client experience and referral partner experience for purchases. And so some of the things that they're exploring are setting up systems that flag when it's the right time for a client to potentially refinance. Obviously, everybody is on the CRM game, the drip email campaign game. If you're TCPA compliant, text, automated text, but those are kind of lazy, passive ways to get back in front of someone. So I think what we're looking at now is more so, how do we proactively meet the client at a point where they're actually ready to purchase or refinance, like when the timing is right, and how do they want us to approach them in those moments? So that's what we're exploring. And one of the things this group in particular is thinking about is having a refi desk to represent the group that is primarily purchase.
And all they're doing is data mining. Just kind of going back and then when they identify an opportunity, do they send it back to the originating loan officer, or do they just handle it there?
They're doing a split. So that the original loan officer is not taken out of it. And if they wanted to take it and run with it fully, then they could, but it's a licensed LOA that they are having split with. So the original loan officer gets the bulk of it.
And that's kind of the interesting part of it, right? Because there's the business model, which is inherently can be perceived as a disincentive, right? Because I might make 120 basis points versus 75, having someone else identify the opportunity and hand it to me. But Greg, we've been so purchase driven, we've been so purchase focused because we've all written off, most of us that are purchase oriented have written off refinances, right? So it's always been so focused in what's ahead of us versus looking at the rearview mirror that our technologies haven't caught up to that. And I think AI I think we see that at NFM with our investments in AI to be able to sort of automate or autonomize that process so that the loan officer has help looking backwards to self-source, quote unquote, self-source those opportunities. But for the most part, the technology hasn't been there. So the onus is on the loan officer's shoulders to do that research. And loan officers aren't the greatest at doing the research, right? Because of maybe compensation or their focus on getting their full comp versus, leveraging, other mechanisms to do that, right? I mean, there are like other companies out there in the business that specialize or at least market themselves as identifying opportunities through digital acquisitions and then distributing the leads to loan officers. But it ends up going to the loan officers that make the lowest amount of comp. And those typically aren't the best loan officers. So they're not really that great from a talent standpoint because if I brought to Greg a loan officer that gets company leads, regardless of what channel, automatically, even if he doesn't say it, it's going to be a yellow flag. Like, how hard does this person work? Do they just sit around and get leads? So we naturally are biased toward that purchase loan officer that isn't looking in the rearview mirror, in as much
Rick,
as we might want them to.
The hand on the head thing while you talk, is that help keep you sharp? I like that. I'm going to try that. Because you're sounding amazing today. I'm not making fun of you, by the way. I promise.
No, that's okay. I have so much real estate up here.
Okay.
Inventory just went up 3% this year, just as a result of this right here.
I want to see the graph.
Rick and I are heading to Turkey. Let me just tell you that right now. Coby, you've been quiet for a while. 2025. Well, you probably have a thought that you want to talk about. So share that thought. Plus, what was the big thing in 25 that you'll remember?
Yeah, the thought that, so two things. I have two little thoughts here. One, we've traditionally been a transactional business. We have never been the model of like the financial advisor that keeps in touch with the customer and does regular check-ins with them. We've always been a very transactional business, and that's the reason a lot of that is walking away. The reason we've been a transactional business, I think, for the most part, is because we've never really understood who owns the customer, right? Is it the loan officer? Is it the lender? Who should be doing the marketing? And then where do those leads go if you are doing the marketing to stay in front of that customer? I think that's caused a lot of confusion between lenders. Also, you have loan officers that leave. What happens to those customers? Does that count against that 75 or 80%? So I think that we need to solve some problems around this, but we don't need to get 10% or 20% better. We can get 5% better just by picking up the freaking phone and checking in on our customers and saying, hey, how are you doing? What can I help you with today? And by the way, I want to talk to you about where your home is at from an appreciation standpoint and a loan principal pay down standpoint for the last few months. So little things like that loan officers can do can really move the needle. You asked about 2025 and what I thought, was it the biggest surprise of 2025? Yeah. So the thing that I kept coming back to, there weren't a lot of surprises in 2025, but to me, the biggest one had to be Bill Pulte. Coming into last year, and I know that there's a lot of different takes on this, and you and I have a different take on this, but here was a guy that we thought we finally had our industry guy coming in to lead the FHFA and someone that was almost a housing insider that really understood our business and what we do and really understood the problems that face home buyers and affordability and all the issues that we talk about on a daily basis. To me, the biggest surprise was what he did in the role and what he spent his time doing. That to me was a big surprise and also a big letdown. So it was surprising and a disappointment at the same time. Everything else that happened last year, from the vertical integration to the consolidation to, the amount of transactions we did to where rates were, none of that surprised me, but that to me was the biggest surprise.
Interesting. Yeah. Meaning you were surprised Pulte didn't know more, wasn't more impactful other than the headlines?
I was surprised by how he chose to spend his time. I was surprised by how little in terms of actionable solutions came out of his office. I was surprised in how he treated Barry Habib. I was surprised in how he went after perceived political enemies. I was surprised by just about everything that came out of him or his office on almost a weekly basis. It got to the point where I was no longer surprised, but and I was starting to expect that. But, up until, the portable mortgage, which was just a few weeks ago, it was one thing after another that was bewildering.
Well, and then he got quiet for a long period of time, over 30 days, 45 days. And then he started to come back just a little bit. Yeah, I did a post recently just saying, look, in the first year, this is what I think happens. Not a lot gets done. You shake a lot of trees, you make a lot of noise. This right here, this window right here between now and the midterms is when we see what they can actually do. So I'm still hopeful that something good will materialize. Julia, assumable mortgages, 50-year mortgages, some of the other ideas. The best idea was the LLPAs, but then everybody was like, oh, wow, they're looking at LLPAs. But then we come to learn that was just for second homes and refis. Like, gosh.
I would have loved I would have loved it if we could have come up with a way to pull back on the LLPAs around the 5 and the 7/1 ARMs. Because I think that would have incentivized our government and the Treasury to really come up with solutions where we would be in a better spot 5, 7, 10 years down the line. And our industry too. I thought that would be a really cool play, as opposed to a 50-year. We're just extending how long people are indebted. What happens if you go out to a 50-year, right? Like, okay, so people will start opting for the 50-year because they can go with a higher purchase price, maybe. Is the interest rate really going to be substantially less on a 30 versus 50, just like we saw the gap start to close over the last 7 to 10 years between a 5 and a 7-1 arm versus, or a sorry, let me take that back. Look at a 15-year versus a 30-year 10 years ago. Maybe 2.5% interest rate difference. What is it today? Like 0.5%, 0.75% difference in rate? Like, what would that end up looking like? I don't see the 50-year as the option of the future. I think something that would hold all parties a bit more accountable would have been restructuring the LLPAs. Especially, like I said, around the ARM products.
Well, and Coby, that kind of gets to your point regarding like the lack of consistency from Pulte's desk, because that kind of sort of came and went. The transferable mortgage sort of came and went. So and maybe that's just a way of testing the market, collecting quick feedback, and then determining what sticks and what doesn't. But from a leadership standpoint, it makes it difficult for us, for Greg and I, to actually plan an organization around. To grow to 20 billion or 15 billion. It's like, how do we train our loan officers around these forecasts, right? Or new products that are aiming to hit the market. And then we're trying to translate that so that loan officers know them enough to pitch them to the consumers, other than the standard vanilla Fannie Freddie type loans. It just becomes a really difficult sort of thing to manage. Greg, I would say to me, the surprise was rates weren't as strong as we thought that they were going to end up. We thought there was a lot of forecasts that we'd make it to the mid fives, mid to late fives. I didn't really think that, but I think they ended closer to where everyone really wants them to be. Inventory has loosened up, which has been a really good thing, but I don't think we expected inventory to loosen up to the degree that it has, because about 30% or 26, 27%. Year over year, our inventory is sort of expanded. So that's promising going into 2026 when we know that, 70% or about 35% of all home borrowers are above 5% more, in their interest rate. So there's going to be some mobility factors there in 2026. Which I think fuels what we think to be a much better year. I think the forecasts are 2.2, 2.3 next year. I think that the NBA has for 2026, but they also forecasted that for 2025, right? And in November, December of 2024, they thought we would do 2.3 trillion, and we ended at 2 trillion, which is great. But so we'll see. It'll be interesting. This administration throws curveball after curveball, and they could probably light a match under this industry like that, right? By some bold proposal for builders to really accelerate new construction, to do something. But so far, a lot of their bold proposals have just fallen flat.
So 2.2 trillion is the MBA forecast for 2026, 34% refi. The surprise of 2025 to me, no impact from the NAR settlement. In fact, in some instances, commissions went up.
Great point.
We went into the year. I went into the year. I fell for it, man. I don't know how many times I've fallen for the hype and the rhetoric and been like, "Oh, the world is going to change. Everything's on fire. Oh my goodness, it's all over." It was a nothing. It just was a bleh, right? And so I don't know if that's because real estate agents have such a great power and it's a monopoly, or do they really bring that value? Like, will we ever even know? Who wants to comment on that?
I think it underscores, we work with real estate brokerages at T360. That's a big part of what we do. And so we've had a lot of discussions around this. And this is not T360's official opinion. This is mine. I think it underscores what we've always known about this business, is that customers at the end of the day, they want that guidance. They want that leadership. They want that mentorship. And they're willing to pay for it on transactions that they only do 3, 4, 5 times in their lifetime. It is not something they're going to negotiate down to the thin edge of the pencil on, because if they feel like they're getting good value and good service in what is the biggest purchase of their lives at that moment, they're going to pay for it. And I think that's why it became a non-issue just because the value was already inherent. It was already there, and it was just a matter of explaining it. And I think that it speaks and translates to where we sit in the mortgage industry, in that if we understand that about our customers, that they just want guidance, they want trusted advisors, they want that leadership. And if we can provide it for them, then loan officers are not going to be replaced by AI. We're going to continue to have a seat at the table.
2026. All right, let's tee it up. Ladies first. What are we looking at this year, Julia?
Ladies first. A lot of my work last year had to do with LOS exploration. And it's funny because from an IMB space, we've been talking about going proprietary, or, looking at some of the new players who are API-based, web-based, task-based workflow like Vesta, Wilco, Blue Sage. But last year I picked up quite a few banks and credit unions who were going in the opposite direction. They were saying, we built a proprietary software 30 years ago. All the engineers who built it are now retired, and we can't find anyone who speaks this language of code. So we want to go with somebody tried and true. And I actually stood up quite a few ICE implementations in 2025 for banks and credit unions, which I think plays into what ICE was looking to do, not having such a strong hold in IMB and, having more banks and credit union clientele. But prediction for 26 is, now that Vesta has PennyMac onboarded as their flagship client, that they're going to start having lenders opt in like dominoes, and that they're going to grow a ton.
Interesting. What about Vesta makes them someone to consider, would be my question. And then anybody can jump in behind this, Julie, after you answer it, to talk about the recent news with Tim Bowler moving on to a different department at ICE and Bob Hart moving into that role. I'd love to know, thoughts on both from you, and then you guys can just pick it up from there.
Yeah. So I've got a couple clients that are IMB clients that are exploring either building proprietary LOS outright, or working with a company that's on the rise. And what I found is Vesta's implementations that are already completed with a lot of the preferred vendors and service providers are light years ahead. They've already got integrations with a lot of the preferred companies that would be a blocker for setting up or standing up your own LOS. So, if from a compliance perspective, you're not going to probably build out your own compliance engine, right? So you've got to have that conversation of, okay, who are we going to use for compliance going forward? If we're leaving ICE, if it's not Maven, is it Compliances, or who are we using? And what would that integration timeline look like with them? And then if we're one company and maybe we're, number 32 IMB in the nation, let's say, is that volume enough for them to jump when we ask them to jump if something breaks, like it would be if we were on another LOS where there's a lot more volume and a lot more at stake? And you can look at like Byte as an example, as like a trailing LOS that new tech vendors, as they're getting up and going, are either not integrated with or not optimized as an integration with, because there's just not that much market share there. So that would be my feedback on why I like Vesta. They've done a lot of that hard work already. Their integration team is led by a woman named Monica, who's absolutely brilliant, just like Mike Yu, and a lot of that team. They're really sharp, and they've got a good understanding of mortgage for sure.
Cobe?
Are we talking about the biggest tech movers we think, or the biggest tech implementations?
Yeah, we can pivot into the, tech that you can't ignore in 26. You got a name out there you want to throw out?
No, I don't want to throw out any names, but I'll just comment on what Julia said in terms of these companies that are migrating to more forward-looking LOSs and POS systems. And I think, look, we're heading in, if we do get to 2.2 trillion next year, we're not looking at a huge needle mover in terms of home sales. We're going from 4 million units to 4.2 million units. And I think we're now in year 3 or 4 of whatever we want to call this. And I think we're starting to realize that, hey, we're not going to refinance our way out of it, and we're not going to volume our way out of it. We need to figure out, how do we drive more profit and more revenue and better margins out of the technology that we have, and out of the personnel that we have, and out of the amount of transactions that are available in the market. And I think companies are now opening their eyes a little bit more to those tech solutions. And I think that's why you're probably seeing the changes that you're seeing at ICE, because it's like, hey, we need to get a little bit, we're not going to have 80% market share forever, right? There's a ton of people that are hot on our tail. We need to move the needle on this a little bit and get a little bit more better in terms of the integrations we're allowing, in terms of the SDK migration that they've been promising forever. There needs to be, and that pressure from competitors, I think, is huge. And it's what we scream all day and night about when it comes to FICO and the credit bureaus, is that lack of competition and how we're being stranglehold. So I think 2026 is going to be a year where you're going to see a lot of tech innovation. You're also going to see a lot of tech companies die, because there are a lot of tech vendors out there that have come up with their own problems that they've then come up with solutions to. And they're really not helping anybody. And they're just running around yelling AI, and leadership is just tired of that. So I think we're going to see a very bifurcated year in 2026. We're going to see real strong players emerge on the tech side. And we're going to see a lot of startups that have been floundering for a couple of years finally flame out.
Interesting. There's a definite, I see like less is more. Like we're going to start seeing, like in the CRM space, do we need 100 million journeys? Do we need flyers? Like what is going to just come in and just like, here are the things you need. And it's amazing to me. We've gone 32 minutes without mentioning AI. It's remarkable. But we can't ignore it. We just can't. Like that is going to descend and it's going to make these tech platforms stickier and easier to use. And I think we're going to get to a place personally, Rick, where these systems don't have to be so crazy robust. They just need to do a couple of things really, really well and with a lot of intelligence behind it, so that we can start talking to consumers like we know who they are, instead of talking to them like they're one of 800 applications we've taken that day, which is a huge miss for the industry that I've talked about a lot. Our CRMs are antiquated in that way. And generally speaking, our tech is antiquated in that way. And we've got to find a way to identify who is this customer. If they're a first-time home buyer and they're 24 and they're Gen Z, we should be able to scrub their socials, know what their families. There's like a lot we can put in front of them to show them we know who they are, to make them want to engage, right? Because then the ROI will go up. And as we talk about rate compression and it being harder to make money, those are the things, Rick, I think that can move the needle. And I know that you're heavily involved in the AI space with Inside AI, looking at that a lot. And then also there's a company where you're listed as an advisor on your LinkedIn profile. So go ahead and take your first swing at AI, and what tech should we be looking out for in 26?
Well, I think that I think what's going to drive, like, AI is about data, right? And the more data you have, the more intelligent and the more personalized the experience is going to be. That's why smaller organizations that adopt AI, I think, is going to be less effective than large enterprise organizations, because you just have more of it. So it's going to be smarter, faster. It'll be more intuitive. It'll be more direct and personal with the consumer. And so which plays into our earlier conversation around recapturing of past refinances or past purchase opportunities of our past book of business. So you'll see solutions like Inside.ai that we use effectively. I think really effectively. We'll continue to see that evolve to be able to assist loan officers to do that sort of legwork and the recapture. But I also think, because AI is going to be so, there's a proportionality around the amount of data that you're plugging your AI solution systems into, and in the engagement with the consumer, the effectiveness of that engagement with the consumer, which I think is what's going to continue to drive consolidation of the business. Julie and I are speaking at the IMB conference by the MBA on mergers and acquisitions. And I think part of what's driving this inherent desire by the 400 million, 500 million, the $1 billion a year originator, even $2 or $3 billion originators, the platforms, is that they know intuitively that they will not succeed without either a really coherent data-driven strategy, which leverages AI to convert new business and existing business. And as a result, they'll partner with an organization that will. Mm-hmm. Right. And I think that's going to be the 2026 trend. I think we're going to see, I've never seen, usually like, M&A is a function of weakness in the business. The large organizations are kind of on the prowl to small to mid-sized, more vulnerable organizations. I'm seeing that level of vulnerability on companies which are otherwise very financially solvent, have a lot of money in the bank, have some servicing, but they don't have a strategy. And I think the pressure of AI and to be able to compete for that consumer is going to drive continued consolidation in 2026, which I think fuels the whole AI structure. We talked about Mr. Cooper and Rocket. The question is, once you integrate and align, that's where the conversion takes place.
It doesn't have to be a bad thing, though. Like there are many instances where if you get with the right organization that has those tools, as an owner of a small independent IMB, 400 million to $1 billion, like you might end up driving 20 to 40 more basis points into your bottom line and take all your chips off the table. Like that can really happen.
Yeah,
it happened with the deal that you helped bring to NFM recently. Rick, I see you nodding your head. Julie, I want to talk about the person of the year for 25 real quick because Rick named AI the person of the year in 25. I said it was Terry Schmidt, the head of Guild, for culminating an incredible 40-year run with the sale to Bayview, Lakeview. Julia, Coby, who's your 25 person of the year? You want to give it some thought, Julia? Coby, I know Kobe's got some names. Go ahead, Coby, you go first.
Yeah, I mean, I think the name that I had bantered about, was Varun for me. I mean, that to me, was the biggest move that sent shockwaves through the industry. Those were two massive acquisitions. The idea that someone stepped forth and decided, okay, here's how we're going to control the entire customer journey and control the funnel from point of thought until servicing and retention on the back end. I mean, we saw some copycatting of that. I think 2026 is going to bring more on a smaller scale. I think there's a lot of different ways to do that without making a $14 billion acquisition where you can kind of take the lead from that. I think 2026 is also going to be proof of concept for Rocket. I think they're going to find a way to do it. And as I mentioned in the post you made about Varun, the question is, can they keep their broker channel happy? I think they're going to try to find a way to do that. So I think it has to be Varun. In terms of the impact of the industry, AI is definitely in there. What Terry did for sure. And I'm curious to hear what Julia thinks.
This is a hard one for me. I'm such a team-based person. I think nobody does it alone. Rocket is definitely the player that comes to mind.
Even Teams Magazine, even Time Magazine has a person of the year. I mean, come on.
But it was AI, wasn't it? Also AI, like Rick? Didn't they still?
No, I mean, you gotta. Do you want to?
Maybe Julia wants to pick us for.
Is it Zoe with the tail? What's going on here?
No, well, she's got a toy now. No, I think like Rocket came to mind as like the team of the year for sure, but they also have a rocket sized budget. So like, let me think about it. After this call ends, I'll throw like a comment in the chat.
Comments.
Like,
yeah, I like that. Listen,
like,
listen.
Yeah,
we're getting a glimpse on what it's like to work with Julia. She's not off the cuff. She's very diplomatic. So I like that. I like how thoughtful you are.
Methodical. I would say more methodical.
Very thoughtful. Yeah, no. She's a high level strategist.
I think what you say matters. So I want to make sure I mean what I say.
Oh gosh. I'm gonna have to redo my whole brand then. Shit.
It's my brand. It doesn't have to be your brand.
Coby, I'm dying to know what's behind the curtain. I'm sorry to do this to you.
It could be like open the curtain.
It could be like a million things. The kitchen could be in there. It could be a window. There could be nothing there but a wall.
Do you want to bid on it?
I don't know. Like, what's behind?
Let's do a LinkedIn poll. Let's get Brian to do a LinkedIn poll on it.
I mean, what do you think? What do you think is behind the curtain?
I think that is a window to the outside. That's what I think.
Look at that.
Rick?
On
the person of the year, or what's behind Coby's?
What's more important than his curtain? Are you kidding me?
Is it okay? Here are your choices. Is it outside? Is it a new car, or is it a new washer dryer?
Hey, 26.
Lovely yard.
I'm not giving you my prediction, but now I have to. You know what? I'm going to put it in the chat. Now that I'm trying to. Julia's rubbing off on me. I need a little bit more time to think about it. Oh, you know what? Screw it. I'm just going to go with me. 26. I think it's going to be a better year than 2.2. I think that it's being underplayed the impact that Powell's replacement will have in May. And so a lot of people say, well, depending on who the person is, it could spook markets if it's a yes man or woman, and that could send yields up. Fine. I get it. It's very possible. I think that they're going to find the right candidate. I'm not sure who it's going to be, but I could see an emergency cut or something that excites the market and ignites the market, right? Because we got to bring affordability into focus here, which the other side of that coin is if you make it too hot again, then we're just going to be left with the same problem. Yeah, you pay less for a mortgage payment, but now you got to pay 15% more than the house you wanted 6 months ago. But I think that it's going to be a better year, and I think it's going to have something to do with whoever replaces Powell in May. And Julie, I know you have a hard stop at 1:45. We're going to keep going here for a few more minutes after that. So I'm going to give you the floor to command it here for the next couple of minutes. If you want that long, to just whatever is on your mind, just
open-ended. I'm going to go back to the ICE piece and just say 30% of renewals last year were 12-month renewals. So I'm going to double down on this and say I think this is the year that ICE has got to figure out how to turn those 12-month renewals into something more. It's theirs to lose, because realistically at this point, if you did a 12-month renewal, you're probably a couple months into exploring other options, thinking about the timeline to implement a new LOS. And I think it's going to be exciting to see. I don't know that is going to change. As someone who managed this, I did this at a former company at Lower. I managed mortgage technology. And one of the things we always were thinking about and talking about was, were our vendors' roadmaps aligned with our own? Like sometimes, did we even know? Did we have an awareness of where our vendors were trying to go, or what purposes they were trying to serve, what their mission was with us? And that's where I think Coby's right. We're going to have a lot of dying off of vendors that aren't serving a purpose except for fixing their own problems anymore. And then on the other side, if you were thinking about making a move, now there are some formidable alternatives that may actually be viable that weren't 2 years ago, 3 years ago, 4 years ago. Where I think that you still have risk as an IMB is cost, right? The bloat and the cost of whoever you do pick. I know that that's a big reason a lot of people like to get away from Encompass or talk about getting away from Encompass. But for every M&A deal that we see go through, there's this tech stack conversation that comes into play as well, and how easy it is for people to get acclimated to a new tech stack if they're acquired. And the reality is, if I'm a loan officer and I start closing less deals because there's more friction in my process, that's a liability, right? For me as an LO, for my team. So maybe I don't take the money to come over. Maybe I don't take the retention bonus to come over. Maybe I start having conversations with other companies. So I think the tech stack piece is really important, and it does start with LOS for 2026.
If you look at Tim Bowler, who was the president that was just replaced by Bob Hart, you look at their backgrounds. Tim is he's a treasurer. He worked at the Treasury, was a managing director at Goldman Sachs for a while, actually 7 years, 2 different stints. Vice President of Risk Solutions, JP Morgan. Bob Hart, he's a biz dev guy, knows mortgage, knows relationships, knows people.
Yep.
That's not a mistake. And it really is a central theme to how you make it in this business, bringing the whole conversation back around to how you succeed and fail in this moment. It's all about relationships. It's not going to change. And so if you're if you want to increase your refi pie and not lose it to the other folks who are much more transactional just by nature, they're paying people less money. It's a lot more machine-based. You got to get personal. You got to go deeper with people, right? If you want to build a book of business with real estate agents, you go deeper with those real estate agents. So ICE bit off a lot. They tried to grab every piece. I think the last thing was the Black Knight, right? That was a lot for them to try and take in. And they had the Surefire piece, which has been a calamity. It's difficult. You start making these acquisitions, it's very hard. I mean, you've got the integration piece just from a personnel standpoint, making sure the pieces work. But when you go from, this to this, it's very hard, Rick. It's very hard to manage that. Julie, I'm gonna be respectful of your time. I know you got to roll.
Yeah, thank you for the opportunity. Love talking with you guys.
We're gonna have to do this again sometime. I've loved it. We're not going away, by the way, folks. We're gonna continue to talk for a few more minutes.
Julia, we'll see you in Florida at the IMB conference.
Can't wait.
Looking forward to sharing the stage with you.
Likewise. Thanks for the opportunity, guys.
All right, take care, Julia. Julia Brown, founder and principal at Telescope Advisors.
Yeah, she's great.
Coby.
Yeah.
You have something on the tip of your tongue.
Well, I was saying how brilliant Julia is.
But you waited till she left to say that?
I was about to say it, and hopefully she'll watch this back. I didn't want to cut her off to tell her that. Yeah, I don't know. That's all I had. Coming off of what she was just saying, I mean, she's 100% spot on. I think there's a broader picture for mortgage this coming year, and it's really about a paradigm shift. We have to start looking at our transactions with our customers differently. We have to start, treating there's issues we have with recruiting and the clawbacks and how we recruit loan officers and how we build organizations and how we've been doing that with an eye towards immediate profit versus building a long-term growth culture. There's issues in the way we relate to the real estate industry that we've got to work on. There's a lot of uncertainty around, how do we treat non-QM products and how do we bring them into the fold? I think that's a big thing in 2026 that we're going to have to explore and try to get comfortable with. And how do we make sure that we don't have a repeat of what we had 15 years ago, or now 16 years ago, 17 years ago, however long it was? I think that there's a lot of questions that we have to look hard at and start to make some decisions as an industry into what we really want the next generation to look like. And how we use AI to help us build and not replace. So I think there's some broader questions that need to be answered this coming year and beyond, but I think this coming year is pivotal.
Yeah, non-QM is a big one to look out for. Thanks for pointing that out. I had a very successful loan officer who made it through subprime and Alt-A tell me that non-QM is the new Alt-A. And with all the bets being made from investment institutions and capital markets, paying up for these products, once you get that appetite and you make that financial commitment, and that's where the mistakes get made, because you've got to be able to deliver robust growth. And how do you do that? You do that by creating products. And how do you get traction on new products? Oftentimes it comes with riskier, with taking more shots, expanding the box, if you will. And that is definitely a great one, Coby, to look out for. We've had a lot of people participating in the comments. John Ellis, J.A. Dava, Cecilia Rain, Kate Gurovich wants to know if you need emotional support, Rick. And Suha, I mean, she's been all over this. Roy McGregor. I mean, these are some of the industry's goats. Chris Williams. Who did I leave out here? Jennifer Linus, Sean Murphy. It just goes on and on. Suha has by far been the most active on here, though. Rick, any closing thoughts? Dr. Rock, can you hear me?
Yes, I can hear you. Sorry about that.
No problem, buddy.
I accidentally hit the wrong mute or sound button. No, I think that this is going to be a year of M&A. I genuinely, I'm not saying that for self-serving purposes. I just know like the activity is in the conversation volume is loudest as I've heard it in a long time. And it's from companies that you wouldn't expect it. And I'm just, so I have a feeling we're gonna hear some announcements over the course of the next 3 to 4 months that I'm hearing that are coming down the pike. And I think that we're gonna see some consolidation. And it's not just about, I think it's purely market driven. I think it's purely around strategic moves to make companies be more competitive, or and to leverage technology and the platforms to do so. Because I think that's where Rocket is going to be the most effective once there is that alignment. There's nobody that invests more in technology than Rocket and UWM, and I think that they're going to take advantage of that. And guaranteed rate, probably number 3, but as far as their tech budgets. So I think we're going to see a tremendous amount of consolidation in that regard. Beyond that, I don't know if it's going to be much different than what we saw in the last year. I think we're going to, I think rates, barring anything any consistent follow through from the administration that's going to be truly disruptive in the business. I think we're going to look at a fairly normalized year as we saw in the last 12 months, hovering around 6% plus or minus. And I mean, inventory's not any. I mean, I think they're expecting 1 million, 1.2 million starts this year. So I mean, it's like, yeah, that's kind of vanilla. There's nothing spectacular about that.
Still not building enough.
What will the legacy be, Coby, if the administration, if it's more of the same this year, because they didn't really move the needle in any significant way when it comes to affordability?
Yeah, I mean, just the legacy will be told in the 2026 midterms. And not to make this too political and make it broader than housing, but we're starved for real solutions, and then there are solutions that can be implemented at the push of a button, as many of us have posted over the last year. Here are some easy things that they can do, and if they start to do some of those things, realizing that there's a payoff in those midterm elections, then we might see some of that relief. If they continue to ignore it and continue to come up with pie in the sky ideas that don't really help anybody, more of the same. And I think they're going to take a bath in November.
The MMI fund has a combined capital ratio of 11.47, and the statutory minimum is 2.0. It's almost 6 times what it needs to be. So, look, that's easy, man. I mean, just go and lower MIP. Like, isn't that a solution right off the bat that they can implement? Like the NBA in their comments said that they're going to review this and let us know what they recommend based on that. Could there be a scenario at 6x where they're not like, cut MIP, please? Like, do that now. Like, lower that right now.
I know Brendan McKay and the BAC are working on that. There's actually some legislation that's been written up. I don't know if it's in committee yet. I don't know if it's been sponsored yet. But I know they're working on it. So hopefully that's a solution that comes about. That's a great one. Yeah.
And that's easy, right? And the question is, though, do they want to just keep stuffing those coffers, right? Like, we thought that LLPAs would be reduced in a meaningful way. Come to find out that second mortgages and refis only, they don't help first time buyers. They reward rich people for the most part. So I wonder with this FHA thing, are they going to look at that and go, well, we love what this does to whatever balance sheet. Let's not get off of that. In fact, why don't we leave it where it is, and we might be at 15 within a year. Like, that would be so outlandish.
And what I was going to say, is they've just reduced the affordable lending goals for Fannie and Freddie, and that's going to push more borrowers into FHA. So if they don't give that relief, yes, what they're going to wind up doing is building up those coffers, and they're going to make home ownership less affordable for a lot of people. Yeah. So they almost have to, by default now, give some relief on that side of the fence.
We need more people like you in the room, Coby. I'm asked all the time, like, the President Trump and Director Pulte say, we're going to have sweeping housing changes coming. We're working closely with the industry. I can't find one person they're working with. And I know some pretty important people in the business. I mean, Matt Ishbia and Barry Habib are the two names. Okay. And they're both, you got to respect the hell out of both of them. But last time I looked, Ishbia is not originating his own loans cradle to grave, and Barry Habib isn't at all. So, like, why not get in the trenches? Why not bring in people that are slinging loans from, A to Z, and get their input too? It's not just, you don't just hang in the ivory tower to get solutions. In fact, oftentimes they're not there. They're in the underbelly.
Yeah.
That's my closing statement.
The people in the street. And by the way, I haven't seen you since you FaceTimed me when I was in the airport in Hawaii, and you look like you had gone a few rounds with, non-58-year-old Mike Tyson. And you're looking good, man.
Yeah, I got a little makeup on. You're talking about since my surgery. I still have they really ripped my face apart, man. I'll tell you right now, you got to put sunscreen on, particularly in the nose area. They went in saying it was just going to be one little cut. They were going to sew it up and I'd be gone. They had to go at this thing 4 different times in the same day. So I spent 6 hours, one cut, more needles, one cut, more needles, one cut, more needles, a 4th time. And then they had to put me back together. And it was interesting. It's called Mohs surgery. It was a basal cell. It's not melanoma. You can't die from it, but it can take on a life of its own and grow in your entire face. So the doctor literally drew on my nose to figure out how he was going to sew me up. He's like, oh, I could do this. I could do that. Okay, we're going to go that route. So they took a huge chunk from up here. I'm good, but it's humbling, man. You know, getting old is not fun. I'm in my 50s. I don't think you two are, right? Rick, you're not. Rick, are you going to be 50?
I'm 52.
How about you, Cobe?
48.
You son of a gun.
This
has been great. We have to do this again sometime soon. I hope everybody enjoyed it. I think that's a wrap for the first Monday one-on-one of 2026.
One thing I was going to say, Greg, is that I think Redder was probably the breakout technical star in 2025. I know this is the end of the podcast and people probably logged off by now, but I would say that literally, like, don't you agree with that? A year ago, Redder was not like really part of the industry conversation a year ago. Going into 2025, they just weren't, you know. And now I was just looking at their email they sent out about the market intelligence email powered by Redder that was sent out this morning by James Hooper. And it came down with some really, really good information, some market data points that on LO, transitioning and conversions that were really smart. And I said to myself, gosh, where have these people been, right? And where they've been is where they've come from, and they've come from obscurity to probably the leading data intelligence tool in the country. So, anyways, it was just kind of, I was reflecting on your question on who are some of the vendor and tech emerging partners out there, and it's hard not to. I mean, Redder has gone from used by no one to used by everyone.
Yeah.
Metaphorically speaking.
Good pressure on the industry too. Love it.
All right, guys. This is a wrap. Appreciate it. Now Young, thank you behind the scenes for pushing all the right buttons. We'll see you all next Monday on One-on-One. Enjoy your week.
Take care, guys.
So long.